What is external reporting? Well, it's basically like anything else. It allows companies to provide stakeholders with their internal commitments or performance and goals. It is a way of tracking the internal processes and operations of an organization, but it's a way of providing whole and accurate information to investors. And specifically, what we're talking about with external reporting in terms of sustainability or corporate social responsibility is what are they doing on their economic, social, and environmental aspects of their reporting. Now, why did this reporting come about? Well, there was no real common framework for companies to compare one report against another. A lot of organizations, they had their financial report and then they put out this nice little cute little environmental report or this social or philanthropic report about how great a company they were. But there was no way to compare one against another because there wasn't a common framework. And companies, would write their financial reports, to demonstrate what they were doing for shareholder value, and of course have some good things in there that made their shareholders feel good. But without that common framework, companies could be very selective about what they wanted to disclose, and they could keep certain aspects in the dark to the other shareholders of things they did want to disclose. And so that really led to this need for some common frameworks on external reporting. The four most common types of external reporting, if you're an organization, are corporate social responsibility or CSR reporting. Traditionally, that's done through the Global Reporting Initiative or the GRI. You have external reporting through the CDP, which used to stand for the Carbon Disclosure Project. Now it's just called the CDP because it's actually asking for reporting on not only climate performance, but also water and supply chain. And integrated reporting, which is where a lot of the traditional financial reporting and the sustainability reporting are coming together. And we're going to talk about the two organizations that are leading the charge here, the IIRC and SASB. And we're going to go into more detail about that later in the module. If you look at this slide, you see this is the extent of traditional financial reporting. Okay, everything that you would see on a balance sheet, an income statement, and cash flows, it might be listed in an annual report or a 10K or a 10Q if it's a quarterly report. But more often than not, when an organization wanted to disclose or not disclose what it was doing in the social environmental aspects of their reporting, those would be buried in the notes. So you'd have these beautiful, colorful, photos of look how great we're doing and show graphs showing the financial performance, and then buried in the notes would say, and we've got a liability based on a chemical spill here of $500 million. But it's buried in the notes, so hopefully no one will see it. But it was their way of quote unquote disclosing it, but not just making it open and available for most people to see. Most of us don't have that attention span. I mean, I look back to when I first started going to my very first shareholder meetings, and you'd get these beautiful full and four-color displays of what the company is doing. Everyone's just flipping through about the photos and feeling good and graphs and charts, and no one's really reading the content that's in there. And that's what external reporting is trying to bring and show the light on what's really going on with an organization. Not only from a risk perspective, but from an opportunities perspective in terms of social environmental performance.